agree to all of that. Let's see. So,
Live just on the Desert Blockchain.
it's on desertblockchain.com. And it seems to be frozen. Imagine that.
Never happened.
Oh, maybe I hit the frozen button, the freeze button.
Oh, you did?
It's good. Now it's frozen.
Oh, it's frozen on here, you mean? Oh, yeah, it's frozen on here.
Oh, man.
You gonna stop and restart it?
It's like never fails to screw up.
Thank you.
Yeah, I'll text you. Because my plan was and I can drive it over.
Yeah, our website needs some updates, but yeah, exactly. We were still doing these business things.
It's a fun.
We're trying to get the camera sorted out here.
Camera's working. Well, at least
Not the Logitech camera. Okay.
Refresh it one more time, maybe.
Camera problem.
Try to unplug and plug back in.
That's the mic.
You've got this one, George, already?
Not yet, but I'm going to. Okay, welcome to the Desert Blockchain event on Saturday, November the 11th, 2017, and we're at Grand Canyon University. My name is Jay Carpenter. I'm the founder of Desert Blockchain, and we want to thank Grand Canyon University for working with us to have this awesome space. And if you're not familiar with Desert Blockchain, our intention is to build community, not only here in Phoenix, Arizona, but also pretty much anywhere in the world that's interested in the blockchain conversation and moving this distributed ledger technology forward. So I am delighted to introduce you today to Melanie Swan, who's going to be presenting a talk on payment channels. And if you're not familiar with Melanie, she's a renowned author, the author of Blockchain, a Blueprint for the New Economy, which was published by O'Reilly. And if you're interested, if you're new to blockchain, I highly, highly recommend her as a way to get introduced to this space. So we're going to be tinkering around with a little bit of technical issues on the video and so forth, but please bear with us, and please welcome Melanie Swan.
Thank you so much, Jay. It's really a pleasure to be with you, everybody here. And so the machine will be like this.
The machine, I'm going to just go right to the screen share.
Okay. Perfect. Okay. So as we're getting started, let me just ask a few questions to see who's here. So how many people have Bitcoin with them right now? About 50 to 60% of the room. And Ether? Pretty much the same. Anybody with .eth domain names? Couple.
Really?
Yep, couple. Any ICO investors? Several. Any ICO issuers? Regulated offering? Yes, nice. And what about LedgerX traders? Anybody completely new to Bitcoin? Excellent, great. Well, this talk is a basic talk across a wide range of topics, a little bit of technical explanation and a little bit of conceptual explanation. So the slides, oh, this is the other talk.
That's the wrong topic. Yeah. Oh, I'm sorry.
So I spoke at the Texas Bitcoin conference in Austin a couple of weeks ago on payment channels, and I've updated it for today because this is a really busy time in the Bitcoin and cryptocurrency space. Was anybody inside Scaling Bitcoins at Stanford last weekend? That's a big technical industry conference. It was at Stanford this year. Last year it was in Milan. Next year it's going to be in Tokyo. And it's technical computer scientists getting together to talk about scaling Bitcoin. And then the other big event last week was Ethereum's DevCon in Cancun. Was anybody at that? Yeah. So what, thumbs up, thumbs down? Thumbs way up or exuberance?
We need another couple of days, actually. There's so much.
Yeah, it seemed like a lot. Yeah, good. And very exciting on the dev side, new. So I'm going to give some summaries of some of the key themes from these recent technical conferences, particularly about payment channels, smart contracts, and privacy and cryptography. And then the other thing coming up this week, of course, is the hard fork. So is everybody ready for that? Oh, I haven't.
Suspended.
I did read something about that. So yeah, that's right. It had been upcoming. Thank you. Yeah. So upcoming, more things upcoming, and apparently some other upcoming news as well. And so people are you holding? That is holding on for dear life, not selling at Bitcoin at any price. You were what?
Hodling.
Thank you, hodling. You're hodling for dear life.
Yes.
So people holding. Okay, so the slides will be later. They will be available online at slideshare.net/LaBlada. I'll upload them later. So they'll be available, and already the Texas talk has a lot of similar material. So I'm a technology theorist at Purdue University in Indiana, and my biggest aim is establishing blockchain economics as an academic discipline of study. I'm preparing a syllabus to teach a course in this area, and I have a book project currently. If anybody's interested in contributing a chapter by March, on the blockchainstudies.org website, the CFP with all of the details is available. So as Jay mentioned, I wrote this book, and The reason is because to encourage us to build this world. And it's very exciting now how things are developing. So I encourage us to put on our mindset of innovation because we really are searching for the killer app of blockchain. So somebody is going to develop the Netscape or the Google of blockchains, the killer app that really makes blockchain a useful and usable technology. So I did just mention the Scaling Bitcoins conference at Stanford last week, where I wanted to highlight 4 different themes: privacy, scalability, cryptography, and smart contracts. So really in the privacy space, there is tremendous energy behind zero-knowledge proofs and beyond. And both on public chains like a Bitcoin or Ethereum or Monero or Zcash, but also zero-knowledge proofs for enterprise chains. We're starting to want more privacy in all of our different kinds of blockchain applications. And so are you familiar with zero-knowledge proofs a bit? So the basic idea is that a blockchain transaction has 3 elements: the sender address, the recipient address, and the amount. And so these 3 data elements we're wanting to hide. So a zero-knowledge proof is a means of confirming the validity of the transaction without actually disclosing the 2 addresses and the amount sent. So a couple of points about this. One, probably the most important paper at the conference concerned bulletproofs, which is an idea from, I have the link at the bottom of the slide, but this is, bulletproofs is an efficient range proofs idea. So basically efficient meaning that the proof size is logarithmic, quite small in the witness size, and then a range proof. And so Monero, for example, has been cited that perhaps their range proofs aren't as secure as one might hope. And so figuring out how to do different kinds of more sophisticated zero-knowledge proofs is one of the key research areas. Second point would be about payment channel SLAs. So just like with internet service, how can we give service level agreements and guarantees about the privacy on the network in which you're transacting? And so different kinds of ideas are, if there are so many multiple transactions occurring at the same time, then it's quite easy to hide yours or a real transaction, as well as if there are multiple simultaneous channels open. So you might have the requisite amount of escrow on deposit, and it might be transferred on whichever multiple payment channels are open. So then scalability continues to be a big blockchain issue, where some of the ideas proposed were a fly client. So this is an even thinner version of an SPV client, where it might just have only the latest block of header hashes, not the whole history of that. Very interesting tool is called BlockSci. So this is an explorer platform that you could load any chain's data into and perform some analytics on it. And then Graphene, which is an idea for instead of every block, every node hosting the transaction ledger having to absorb the whole block, it could query out for the relevant transactions in the latest block using an inverse Bloom filter table. So then cryptography continues to be an important discussion, where most signatures currently are of the ECDSA format. Schnorr signatures should start to be available soon. And looking ahead to quantum cryptography, what the implications of that might be for existing chains and the possibility of rewriting the transaction history. No clear answer on that. And then finally, smart contracts. So the idea of payment channels, really, it's not just Lightning. Transaction channels in general is starting to be more of a concept that's arrived for more and more different kinds of platforms, including Ethereum, and is starting to be very much in the vernacular of how we're thinking about blockchains. And then, so I would say this is a wrap up from Scaling Bitcoins at Stanford, and then DevCon seemed to touch on a number of the same themes, and the talks from both conferences are online. Okay, so the structure of this talk is a market update and then payment channels specifically. So let's talk about investing, where ICOs, if you're an investor, you have to be very careful because it is in some sense a crypto day trading. A lot of people may lose a lot of money in these ICOs, of which some seem to be scams. And so it's caveat emptor for investors. On the other hand, as an issuer, this is an amazing new source of fundraising, which cumulatively has importantly surpassed VC funding in the space. So cumulatively since 2014, there have been $3.5 billion raised with ICOs and $2.7 billion raised with traditional venture offerings. And so moreover, not only have ICOs arrived as a fundraising method, the whole concept of token is now in people's minds, where token is not just the currency for fundraising, but rather conducts a variety of different kinds of functions, including voting, dividends, access, participation, and notification. So the point being that ICOs, not even just as a class of financing, but really changing the whole concept of how investing is being done. So as you are no doubt familiar, the US regulatory stance is that if ICOs, as evaluated on a one-by-one basis, if they pass the Howey test and are deemed to be securities, they are a regulated offering. They may qualify for an exemption, but they are a regulated offering in the US. And it makes sense to work with an attorney like Cooley, who is familiar with regulated ICO offerings. Internationally, the climate is quite different. The UK already previously said, we're not going to regulate them. It's completely to your discretion as an investor. China, as you probably also know, has banned them. Russia is expected to have some guidance by year end. I know Germany said something this week about cautioning about the risk. And then there's an interesting situation of Gibraltar with their distributed ledger entity registration feature, which is regulatory arbitrage. In fact, trying to be the Cayman Islands or the Delaware of ICOs, offering specific friendly registrations there.
Excuse me a second. I'll hide that far down at the bottom so people can see them.
So this is a cryptocurrency market cap. It's approximately 200 billion at present. And so that is really pretty impressive. That's the size of a 200th largest country.
Well, I hit it all right.
Well, that's interesting.
If I could use that.
A hard fork.
There we go.
Oh, okay. So our $200 billion market cap, which is the size of a top 50th country. So it's definitely very impressive growth in the crypto space. That does, of course, compare to other large numbers we think of, like the S&P market cap of 22 trillion, or the US GDP of 18.8 trillion. But the point is that the cryptocurrency asset class has gotten institutional investor interest, and they are seeking many different kinds of ways to invest in the crypto space in a regulated product. Are people familiar with the LedgerX options? So this is notable as the first ever regulated options offering for Bitcoin. And these cryptocurrencies are only available to large private institutional investors. But notably, the firm cleared $1 million of business in the first week of operation and $2 million in their second week of operation. They just started operating. So it's very, very exciting indication of institutional investor interest in this space. They have a note on their website. Please note, we are throttling participation due to outsized demand. And then the other two upcoming possibilities for a regulated product are the CME Bitcoin futures contracts, which are expected now in the fourth quarter, and also another CBOE Bitcoin futures contract as well. And so this is very significant because the moment an institutional investor can just look on their workspace and see these new kinds of crypto options and invest from their usual platform, there could be a huge demand for this kind of product. These institutional investors currently, they do want exposure to the cryptographic asset class, which, as I mentioned, is 200 billion in market cap right now, but estimated to grow significantly. And so far, their only options are to work with dark pools, which are institutional exchanges for contracts for difference and other kinds of investing. But now they'll have a chance to have regulated futures and options, as well as regulated ICOs.
Excuse me, Melanie. Can everybody hear back there? Okay. Good. Thank you.
Okay, so just to, I guess my comment for what I see the most excitement around now when I'm out at different meetings is people using private chains. So are people using Monero, Zcash for transactions? A bit in here. So the people are very, very interested in the privacy benefits of blockchains, particularly in a post-Equifax world. And so I just wanted to mention also to make you aware of Shift, which does real-time conversion to, it's essentially a debit or a Visa debit card with a live connection to Coinbase. So you can actually start to transact nearly 100% of your volume if you're wanting to with this kind of product. So my reaction is that privacy seems to be much more important. Perhaps historically we seem to have a lot of privacy. Now we've been in this surveillance era where there's been this bizarre calculus of we have to surveil everybody because of a few bad apples, but we don't do it well. So we have this centralized cryptographic methods just don't seem to work. We have this Equifax breach and other hacking scandals all the time. And so there's really a lot of demand for the pendulum swinging back to a possibility of having more balance, more privacy. What I noticed from a social theory perspective is that I think privacy is just the first battle. I think this is going to be a very long and very protracted battle for control and power. And what's really at stake is how we organize society. And what will be happening is we don't design the new process. It bubbles up emergently from users like us starting to use private chains and eventually produces different kinds of social change. I have this biography, Ron Chernow's biography of George Washington here, because I really like the class of thinking in that book that Washington knew he was creating a precedent that everybody would be looking back to for generations to come. And so this is really the class of thinking that I would like us to have as we're innovating in the blockchain space. Which another point is blockchain is about finally digitizing economics and government for the internet era. And we're so busy implementing the economic side, we're almost forgetting that it's about the governance side as well. And so I'm starting to get more and more emails of blockchain voting startups. And so this is going to just be the second inning to me of what we're doing. Okay, so now going into payment channels. So if we think about network architectures, we've had the centralized hierarchical method. We've had a distributed, a decentralized method based on hubs and spokes. And now we're really thinking of distributed networks in a completely different way, where these are all individual equal peers. The radical point is that every node is a peer that can provide services to the other nodes. And indeed, this is the architecture that we have unfolding so far with Bitcoin. The transaction hosting is performed by peer nodes. The ledger confirmation and updating, the mining operation, is performed by peer nodes. There are news services. Are people participating in Steemit and other kinds of news services? Great. And then the implication of payment channels is that every node might provide banking services. Every cell phone becomes a bank. Well, how many cell phones is that? oh, well, there are about 5 billion cell phone users worldwide that might start to become a pure bank. And one question, of course, is, are we really ready for this? And is a Bloom filter on a blockchain perhaps a worse version of a FICO score in terms of an algorithmically determined reality that I don't know how it works or exude much control over? But that's a separate concern. So here's an example of a bottom-up finance startup called La Plataforma, a platform for plata, for silver, for sending money, that a colleague of mine runs in Chile. So payment channels. I forgot to ask, people have Lightning nodes up and running? Anyone?
Rated.
A Raiden node or a Lightning wallet? So you can download and try to get this going on the test net right now. So payment channel. And are you familiar with payment channels? A bit as a concept and yeah, okay, fantastic. So I'll be talking a little bit about the technical side of payment channels and then the economic implications and meaning as well. So a payment channel, the concept is that, first of all, a network, or the two important concepts to understand for payment channels. And the first one is that the network is a graph. It's a computational graph composed of vertices and edges, or nodes and the links between them. And that means on this computation graph, we have a payment graph, a credit graph, a transaction graph, a flow through of nodes on a network, very similar to a deep learning network. The second concept is net clearing. So this idea of contracts for difference or spread betting. So I'm just going to bet on the spread of the game, not the whole total score. And so the possibility of having this kind of idea, we do many more kinds of transactions on a net cleared basis rather than a gross cleared basis. So in the financial world, contracts for difference usually come with a 10x leverage, just like an options or futures contract. But I'm not suggesting that that leverage component would be part of the contracts for difference or net cleared economy, just that we'd settle on a net basis. So the idea is that we might have an account or run a tab with many more entities over a longer period of time. A payment channel is a three-step financial contract. First of all, one party opens a payment channel with another and posts a prepaid escrow amount on file. Then the second step is that the party consumes against this credit over the given time period. The incremental activity is tracked. And then third, at the end of the period, the cumulative activity is booked in one net transaction to close the contract. The motivation for payment channels is, first of all, to improve the scalability of through a contractually obligated relationship that's booked as periodic net activity. Original idea came from micropayments for things like video consumption by the minute, where it doesn't make sense to actually book a transaction for these at this piecemeal level. The current maximum in the Lightning Network, the current maximum amount that you can have a payment channel for is 4% of the value of a Bitcoin, which translates to about $250 right now. The bigger implication, I think, is of the concept more generally of payment channels, whereby this might develop into a digitized payment system for resource consumption that settles on net payments instead of gross transfers and enables peer-to-peer banking services. So there is very sophisticated functionality. The key point about payment channels is why they're becoming very popular right now, is that it will be very easy to do them now with, well, potentially with the SegWit 2x upgrade with the hard fork. And that's because of platforms like the Lightning Network to do a payment channel. It's an application for payment channels. You can do payment channels now. The functionality exists. You would use some of the opcodes like check lock time verify or check sequence verify. So it's very easy. I can open a payment channel with you right now. It just will involve some coding and scripting. But the point is that the Lightning Network will make this very easy, allegedly, to do wide-scale payment channels. Okay, so I have 5 levels of examples. This is payment contract level 1, a Starbucks example. So here, say you're a customer and you open up a $50 monthly payment channel with Starbucks. Then the daily coffee you consume is tracked against and booked against the $50 credit on file. Activity is netted at the end of the month. Contracts close and roll over at regular intervals. Either party may close the channel early. Settlement. So I submit to you that Starbucks is in fact already a prototypical payment channel in that 41% of store purchases are made via their loyalty program, apps and cards. So they already have a form of a basic form of a payment channel. And on their balance sheet, what happens is they've actually just been able to raise $1.2 billion in cash with their loyalty prepays. But they are, of course, obligated on the liability side with that same $1.2 billion stored value card liability. So even in this very simple example, already a host of issues come up, particularly about the accounting and legal treatment. So it's very exciting because the whole promise of cryptocurrencies has been programmable money, and payment channels is a way that we start to see that actually unfolding. We notice other kinds of feature sets from financial contracts like prepayment risk. If either party can close the channel early, that triggers a prepayment risk situation. Also, payment channels are a lot like options. Maybe there's a European or American style execution feature to them. And this issue of fractional reserves about the committed escrow. From an accounting perspective, how do we treat payment channels? Are payment channels a deferred payment, an installment sale? What is the appropriate revenue recognition model or liability recognition? So for example, in the Lightning node, the no upstream transaction takes place until the downstream transaction has taken place. There's a locked contract. And so that actually creates a loan obligation in every hop in the network. So if you're running a Ripple transaction credit line or a Lightning Network credit line, how do you recognize this intermittent loan liability? From a legal perspective, are payment channels assignments of claims or maybe forward-looking IOUs? It's not clear how how payment channels will be fit into our existing structure for GAAP accounting and for legal obligations. This is payment channel level 2. It's a small group concatenated payment channel. So for example, there's a local bar, we have Lynn and Chris and a bartender. So Lynn has a $10 tab with the bartender and has consumed $6 against that. Chris has a $10 tab with the bartender and has consumed $5 against it. The two play pool and Chris ends up owing Lynn $5. So I have the specific ledger balances of the AR and AP, the accounts receivable and payable for each party. And the point being that on the current method, the settlement would be on a gross basis. Each party would transfer the gross amount owed to the other parties, which would result in 3 transactions and $16 worth of gross flow. Instead, in the net settlement payment channel method, only all obligations would be netted to the simplest, most efficient closing and settling of the transactions, where in this case that would be 2 transactions for $11 of gross flow. So already one implication is that less money needs to change hands, which means it's available to be used for other purposes. Payment channel level 3. So what if you consider my monthly expenses example? I argue that many of us might already be having a de facto payment channel going on in our bank account. We have direct deposit coming in, say salary, and we have auto pay outflows going on. So that could be simply netted. All of that activity could be wheeled into a payment contract and settled on a net basis. That suggests then I think about my monthly expenses, then I think about my apartment building's monthly expenses. They too have expected inflows coming in, fixed and variable outflows going out in a payment channel-like format, and some sort of net basis. You could also have small businesses considering their monthly flows on a net basis. So you can see how this could roll up. And the next biggest level would be the supply chain. So on a supply chain payment graph economy, you might have what immediately becomes obvious. Blockchains have only been subregisters of the cash account. Really just one big ledger, subledger of what's going on in the cash account. You have different kinds of cash balances going on the blockchain. But now we can have a much more robust idea of supply chain finance, where the entire suite of general ledger accounts is distributed ledger based on a blockchain, such that the entire segmented supply chains could be net settled. Payment channels level 4. So this is a Kevin Bacon example. So basically, with Kevin Bacon, I don't need to know Kevin Bacon, but maybe with 5 hops of social networks, somebody does know Kevin Bacon. Likewise, on a payment graph, I don't need to know the party I don't have to have a payment channel open with the party I'm transferring to, but the credit links could support the transfer via the network. And what we see via the Ripple network is, in fact, it's between 1 and 3 hops for any party to transfer to their final party. And the idea is that perhaps the entire Bitcoin blockchain or blockchain network becomes a large multi-hop payment graph for transporting payments. And this is really the idea behind, the bigger idea behind the Lightning Network and the idea of peer-to-peer banking. So one question comes up as to what about the scalability of these one-to-one payment channels? And so, for example, if I have $10 and it's obligated here with this party, I can't also obligate it over here with this party. So it's fractional reserves question. I only have 1 watt of cash and I can only commit it once to a payment channel. So how is that going to work? So maybe I have a payment channel with Jay, and then Jay has a payment channel with Corey, but Jay actually has to have sort of double the amount available to receive my payment in and to flow it out to Corey. And so the implications of actually being, it sounds great to be your own banker on your cell phone, pure node, but the implications are something that maybe not everybody wants to deal with. Does everybody really want to be a pure banking host? Likewise, so one issue is the amount of escrow, that perhaps I have to deposit much more into the payment channel to support the credit flow through from everybody who wants to come through my node than is the actual transaction volume that I need to use. Furthermore, what about the timing of flows? So we all get paid at the same kinds of intervals during the month. So that loads the channel, but then when I need to use the channel myself, does anybody else, is that going to be available for me? So there are a lot of things that we don't know yet because we haven't tried to work this out. But if we actually, what if this room, we were actually all a peer banking network for each other? How would that actually work in practicality? So yes, the confirmation, the timing, the max flow, and the fees. Oh yeah, then the other thing is when I'm a peer node, I have to sort of be on 24 hours a day. So what if Jay wants to transfer money? He needs to wait to make sure I'm checking my wallet to confirm and transfer the funds through my link. That's another aspect, another potential responsibility of being a peer node banker that not everybody wants, of course. So the idea for Lightning is perhaps 2 different paradigms. Either every node is a peer banker, or there might be a hub model. So one proposal for Lightning is that there are local hubs or gateways, so nobody is ever more than 1 or 2 hops away from a payment gateway. Although that suggests the same escrow issue. Do you have to have exponential increases in the amount of escrow deposited because it can only be committed to one location. So this is just a flavor for the kinds of issues that are coming out as we think about really implementing payment channels. And then payment channel level 5. This is the Mike Hearn example. So Mike Hearn suggested that we'll have smart networks that auto-sense demand for certain resources, like a self-driving car, which would auto-instantiate itself, raise funds, and operate per sensing network demand. So similarly, banking services could do this too. The smart network could instantiate banking services directly upon sensing demand for credit or other kinds of financial services, where such that the network node does not need to be human-backed. Technically, it's not necessary to have a human behind it. Our systems invest the grounding of roles and responsibilities in individual personhood agents for taxation and other kinds of reasons, but there's no real reason the network couldn't just operate the banking operations itself. So the bigger implications of payment channels, with money and payments digitized and activity being securely forward committed by payment contracts, that the net flows instead of the gross flows in the economy might be transferred. An economy based on net clearing rather than gross transfers could mean more activity and less debt. This could allow us to attack a current problem of rethinking debt, where we maybe have a concept of streaming money, much smaller amounts of capital disgorged on demand that are more closely tied to costs and repayment possibilities. The challenge is how to construct a net versus gross obligation for something like a home mortgage. If I wanted to create this business, how would I do that? A student loan, public works projects like a bridge, or bond offerings. So this calls into question payment channels are in regard to prepaid consumption. With that escrow on file, we consume against it and settle it. But most of our economy takes place on credit terms, the entire supply chain, for example. So if we were thinking of supply chain finance, one issue is that the incentive is to play the float, delay payment as long as possible. So we could have digitized streaming money and payment channels applied to quicken the 60, 90-day vendor terms and uncollectible debt problems in supply chain finance. So Lightning, because Lightning is very exciting, very new, it's a payment graph, but really we've already had an existing example of a payment graph in the form of Ripple already operating for 5 years. So Ripple has about 250,000 nodes, 27 million transactions have taken place. It's all open. You can download and review the transaction history and do some analysis, maybe with the SciBlock Explorer I mentioned at the top of the talk. And a few things to mention about Ripple are first of all, the highly interoperable transactions. So it's cross-border fiat remittance. It's cryptocurrency exchange. You can also have user-defined currencies. And they have, with their new ILP, integrated ledger protocol, integrated payment methods. So it doesn't matter if you're on Alipay and I'm on US dollars, you're on Bitcoin, you're on Ethereum. We can all play together and we don't have to think about it. The other important functionality of Ripple is that it's not just money, it's credit. So every node has access to cash, access to credit, and the ability to issue credit. So you can issue credit to other parties and receive credit. So as I mentioned, there's 5 years of operating data, and 12 of the world's 50 largest banks are participants in the Ripple network. It's a very interesting beast. It's open. Anybody can become a node, a payment gateway node, or a market maker, and they encourage market makers. You can make fees for this. So it's an interesting mix of being an open network. The consensus operation is performed by validators, of which there are 55, and transaction blocks close every 4 seconds.
Melanie, did the validators have to stake to become a
It's a
validator?
proof of stake system.
Right.
They are approved and validated, and it's not a traditional proof of stake method like we think of from Ethereum or from staked coin, but they're staked in the sense of validated and obligated. So here's just an example of how the Ripple credit network works. So again, it's this idea of a computation graph where we have nodes and edges, or vertices and edges, where with the wallet balance being in the node, and then the credit link, the amount of credit, which could be one way or two ways, flowing between the nodes. And so in this particular example, we have Dave in the top left wanting to pay $50 to Eve in the top right, and the transaction needs to go through Fannie. And so as that transaction ripples automatically through the network, Dave's wallet balance gets updated, the amount available on the credit link gets updated, Fannie has offsetting transactions, the outgoing credit link is updated to Eve. And how most of these transactions work is that, and then Eve could take delivery either of the actual money balance or just the availability of additional credit in the network from the prior node. And so then there's a further idea of Bitcoin is mainly just the cash, a subledgers off the cash account of the balance sheet, and Ripple starts to add credit, AR and AP. Then what about the idea of putting the entire suite of income statement, balance sheet, cash flow statements onto distributed ledgers? We could have the idea of Ripple for ERP. So why don't we just implement Ripple in supply chain, where the idea would be integrated ledgers amongst trading partners with open permission links in corporate accounting software such that trade partners could post or pre-post to each other's ledgers. And the reason we would want to do this is we could net clear the supply chain and not have the gross level finance transaction transferring between each pair of parties. The problem is that 3.9 trillion is tied up in working capital in the global supply chain. Likewise, there's a $1.5 trillion trade gap in goods that want to be shipped but can't obtain financing ahead of time for it. So this could be an important demonstration example of payment channels and net clearing for the blockchain economy. The implementation of this could come through the blockchain cloud services vendors that have offerings already, and also the big four. So there might be trusted hosting of these integrated ledgers in the supply chain. So further, payment graphs are also not so new a concept when we consider the very many automatic trading or algorithmic economic aspects that are part of our contemporary reality. It's already hedge fund trading, real-time bidding for advertising space on the web, and global energy trading are all vast algorithmic operations. And so now we're just talking about doing the same for banking and finance. Ripple's 27 million transactions so far. Dfinity is a startup in Palo Alto that has an automated commercial loan approval system. Payments is another implementation of a graph becoming a payment graph. So concluding on this part, the idea is how can we use these kinds of concepts, payment channels, net clearing, integrated ledgers, first working on a larger class of economic problems that are facing us at the moment. So particularly debt. Also, we notice that the economic incentive and the outcome are not aligned in many areas. And that includes supply chain, where the incentive is to play the float, not to settle quickly. Likewise, in healthcare, There's no focus on price rationalization, but there is a focus on consumption. Entitlements is another area that we might try to attack, supply other answers to with payment channels. Also income inequality and the digital divide. And the automation economy. How are we going to have orchestrate an orderly transition to situations of greater technological unemployment, of outsourcing jobs to technology? So how could we move to an Uber or Airbnb economy for financial assets like securities? So I no longer have to own music or videos or cars or houses because I have a liquidity of the consumable benefit of the asset available to me with Uber. But I still have to own securities because I don't trust their future value. So what's a blockchain-based method where I could have access to the consumable benefit of the asset, namely dividends of capital appreciation, without actually having to own the underlying asset? So these are the kinds of questions we might try to attack. Then a few pages of resources. I have some with colleagues, some recent publications, and both on blockchain philosophy and blockchain economics. This is the CFP for my current book project on blockchain economics. Please consider submitting a chapter. And some different digital ledger standards bodies. So a blockchain is a ledger running on a distributed network. So as quickly as we can have standards for this, both on the accounting and finance side, and on the network IETF W3 working group side, we'll be able to integrate these kinds of technologies into our economy more robustly. Thank you. I think Jay will moderate questions now.
Sure.
Okay.
Starting with my
Yes.
question. So Melanie, thank you very much, first of all, for that great presentation. That opens up some, I think, some huge possibilities in this distributed ledger realm. And I've heard a lot about zero interest loans. What's your view on zero interest loans?
Yeah, I really like a book on this called The Curse of Cash. Are you familiar with that book? So this low or zero interest loans or low interest loans, we've been now in this very low interest rate environment for several years. And this book discusses how it's a macroeconomic policy objective of countries worldwide to continue to preserve a low interest rate environment. And so I think these days of being able to really see fixed income investments as an investment and count on interest from fixed income instruments is not really any kind of economy that's going to be coming back. So my sense is your question about zero interest rate loans, you mean, is it a good idea for to make them, to receive them?
It's just, so I have an undergraduate degree and a graduate degree in finance, and the notion of a loan having a zero interest is like anti-gravity to me.
Okay.
So, it just doesn't, I can't get my arms around it. I can understand a low interest loan, that flies, but a zero interest loan, like borrowing against myself or something, So then my question would be, because in all of the payment channel talk, I hear there's always with an interest rate, with a tiny interest rate. Well, my intuition is there has to be some sort of explicit or implicit interest rate built in. Yeah, so the cost of capital. Cost of capital. Yeah, absolutely. And so I think one of the interesting applications of deep learning algorithms is actually figuring out what is the right cost of capital in these new blockchain economies. And so that includes what's the right amount of fees for the transaction, and that includes what's the right amount of interest. So exactly. So very interestingly, on my understanding of Ripple is that the main payment gateways don't make any transaction fee, essentially an interest rate, for flowing the credit through the network. It's very much a peer-based network in that sense. I'm just going to flow credit through my node. Market makers do make a fee.
And so I think I don't think anybody's thinking that capital would be free. And I think it's very much an interesting math and computer science problem of what's the right cost of capital and how do we determine that. And so also with blockchain fees, then you see people doing arbitrage like, oh, I'm going to submit my transaction when it's not prime business hours in the US because it's going to be, I can get a lower fee on my transaction. So people are already playing the arbitrage opportunities with when to submit transactions and what the right fee should be. So I think figuring out the cost of capital in these blockchain models is an important problem. And I don't think anybody's thinking it would be zero.
Okay.
Say something about
We've in this room, we've heard zero interest loans.
Oh, that's interesting. On what application?
It'll remain nameless
Oh, okay.
at this point, but
there's negative interest loans, things like that are
That's
happening
true.
in Europe and Japan.
Yes.
So to me, it's like not that complicated. I don't know, just thinking out loud.
Yeah.
It's because we're talking about preservation of capital. They pay the bank to hold their gold bars or their cash. So that's where that comes from.
Yeah.
That's
Yeah.
a great point. And, negative interest is also a bit of a mind bender for me, but I see that as an anomaly rather than an ongoing,
That's just for us here. I think,
well,
in my sort of,
I'm just looking at structurally, how can you have a over time zero interest borrowing capability that because of this distributed ledger that
Yeah, I didn't see anybody offering me free money yet.
well that's
but
anyway,
it is.
we don't have to go down that rabbit hole.
And this,
here.
High levels,
certainly there's
free
de
money is
facto.
available,
Oh,
as long as you pay it back on time.
So-
yes,
I mean-
and de facto zero interest or negative interest loans. So I think, this is a bigger macroeconomic discussion, but I think, I don't see it being at all, I see it being assumed that there's going to be a small fee for things on blockchain economies and what's the right fee. That's what I
but it-
mainly see.
The proposition that was proposed was that if you have some sort of asset, you could get a zero interest loan against that asset.
Oh,
No
that's
matter-
collateral.
no matter what the interest rate, the general market interest rates might be going,
That's because you own the assets and you're funding it, really. Even though it's zero to yourself, you still own the assets.
Yeah, and
That's
that's like
loving
but I'm like chasing my tail in that situation. I still don't get that, but that's okay. I'm slow.
And then I guess it also speaks to the variety, the experimental aspect of let's try all kinds of financial models and see what sticks.
Oh yeah, that I'm totally cool with that. I just am having a hard time of loaning myself money on my assets at a zero interest rate. So
Yeah, and typically you take a charge for that on your books.
so
But also, oh, right, but I think that also the bigger issue is how do I know that's the actual future cost of this money? Because we don't know like the real future cost of many of these options yet.
sure. Well, there's even if you look at it from that standpoint, there's some sort of implicit or explicit risk factor
Yes.
that demands
And what's that? What's the cost of that?
demands sort of some sort of
Yeah.
Jason.
Okay, so just as we saw, I think Bitcoin as, and I think a lot of us in this room have had this conversation. We saw Bitcoin as kind of the first killer application of blockchain, where it was a application specifically for finance and for currency and distributed ledgers. And then we saw something come along like Ethereum for basically a different type of thing where now we have kind of a consensus and finance application with Bitcoin and a computation type application with Ethereum. Going forward, in my opinion, the coolest applications coming up are things like Lightning, things like Raven, things like Plasma, the different types of blockchains on blockchains scenarios. Whereas I see Raven and Lightning as this first killer application of these new types of solutions going forward. My question is, what are in your opinion, what are the secondary applications, like maybe generalized state channels, where now we're opening channels that are specifically for maybe data exchange or for computational exchange versus
I
financial
like that.
exchange.
So payment channels for non-currency exchange.
Yeah.
I like that. I haven't thought about that. I like that. I think that's quite useful. So I think when I think about it, I think of Bitcoin, I think of the cryptocurrencies, that's the spot market for cash. I think of smart contracts as futures. This is a futures market, so I can do futural transactions like a mortgage. And then Ripple is different. That's a credit network. Issue and receive credit. So that's a different concept. A payment channel is this contractually obligated booked escrow and consumed consumption or periodic consumption against the escrow with a netting transaction at the end. I've proposed this idea of integrated ledgers across the supply chain where we post to partner ledgers to get a net view. I didn't think about yet this idea of the payment channel concept for non-monetary currencies. I think that's great. And it might be easier to prove the concept on other non-monetary currencies. So it makes me think of, say, Facebook, or Instagram, where the currency is attention, or Facebook, or LinkedIn, say the currency is reputation. So how can we use a payment channel on these other? We're clearly in a multi-currency society with cash kinds of currencies and attention, reputation, ideas, health, many other kinds of currencies. You mentioned storage and bandwidth consumption, maybe. So yeah, that's very cool. So is there, what's Lightning for IPFS?
Correct.
And that, or compute power. So how could I use a payment channel to maybe harness some of this excess, this entropic proof of work compute power for some other green purpose or whatever? I like that idea a lot. Thank you.
Yeah, well, interesting you mentioned that. Jason has participated in a hackathon that was sponsored by Consensus for over a month, and he's part of a team.
Yep.
And they're going to be announcing the results, next Friday?
Yeah, I mean, we can announce that.
We can announce it. So, what would they say?
I don't know.
So you won.
Yeah.
So Jason's team won out of 300 participants.
Congratulations. Consensus hackathon is a big deal. For an application using alt currency payment channels?
Not specifically using payment channels for this. So the product demo pitch. So what we had done was we created a decentralized marketplace for carbon. So people who are sequestering carbon from the atmosphere and people who are wanting to purchase those offsets. So basically a smart contract that exists that when a ton of CO2 is sequestered from the atmosphere, deploys a smart contract that when that contract receives a token, it retires and transfers the ownership of the ton of carbon from the seller to the buyer. So that was specifically that. But there are some interesting implications of proof of work based consensus mechanisms where I did the calculation where effectively every block that's propagated in the Ethereum network puts out about 2.5 tons of carbon into the atmosphere. So starting to think about more generalized state channels where we can exchange data for whatever it might be. Maybe I use some work for some effort to perhaps you exchange back to me proof that you have used that to do something useful, some useful work algorithms.
Yeah, I completely agree with that. Economics is merely this discovery and exchange of resources, of which they aren't just monetary.
Winket.
If we are creating a payment channel between two parties using an app, using the public blockchain like Ethereum, in that scenario, do we really need MTL? That's one question. And second one is, do we have the obligation on the escrow?
What's MTL?
a money transfer license?
Oh, I see. Yes, this is a really good question. I've been concerned about this. So later you may, so the way I understand it, if you're periodically, it's sort of like the day trading rules. If you're periodically engaging in larger, not, more than $100 level kinds of transactions for the purpose of profit, then you constitute a money transmission business, and you're required to be licensed for that. And that's a federal designation, and there may be a state implication as well.
So we are just dealing with the cryptocurrency, no fiat at all.
So it's interesting, and the zero interest point comes up, because what if I am a payment channel and I'm doing tons of business, but I'm not making a profit from it? So then I'm not a money transmitter business. So I'm providing pure architecture. I'm just like hosting Bitcoin D node. I'm providing pure infrastructure for the effort. I'm supporting the blockchain project. But the minute I start charging interest on my payment channel activity, then I'm a money transmitter. So I think it's an interesting, I think we'll start to see this ecosystem developing very much in knowledge of the current regulations.
I think there's another dimension to that in the whole spirit of the money transfer license. In addition to the profit element, I think there's also sort of a trust or trustee fiduciary responsibility, and I'm not an attorney,
you mean
obviously.
The KYC, AML?
No, I'm talking about money transfer license is basically, if I'm going to transfer money through J, if Melanie's going to transfer money through J, Melanie might be interested to see if J has a money transfer license before you give me $1, because even if I'm not making any money on it, you still want some sort of assurance
okay, to be your
that I'm not going to go to Mexico with your money, basically, even if I'm supposedly not making any money on it.
Yeah, so it's favorable customer signaling. Yeah, exactly.
Well, favorable infrastructure signaling, or trusted infrastructure signaling that the state has put a stamp, and Jay's done some sort of vetting by the state that Jay's worthy of transferring.
Or you're a compliant entity.
Yeah.
Yeah, there's probably
When in reality, I'm going to do an experiment at the local bar on the Lightning payment structure, where I'll be ordering drinks all night and hopefully settle up with your money.
Right, exactly, yeah. So I think it's a very interesting point, and I think the regulation is lags, of course, but it will, one can imagine in a year there'll be some sort of payment channel regulation.
So here, in this case, when we say money, it's only cryptocurrency, and you're on Ethereum network, you're on him, and I'm creating a channel to send the money between both of you. But eventually, the transaction is recorded on the blockchain, not on my system at all. And I'm just giving a user interface to do that activity and take some fee for it.
Okay, so that last part, take some fee for it, is what makes all the difference.
Okay.
And so this is why Zcash sits there in San Francisco, not a worry in the world, no money transmitter, MTB, it's not an MTB, because it provides a protocol, it provides the pipes, it's SBC. But the second you start taking a fee, everything's different. And then the other point is, right now we can't do cross-chain payment channels, but so there's no interledger protocol for that. So if you're on Ethereum, I'm on Bitcoin or whatever. But ARC is one example so far of starting to integrate a couple of different chains for the purpose of payment channels. But the main character of your question is about the small fee.
Well, there are other interledger initiatives, like what, Cosmos and
Tendermint
and Cosmos and so forth.
Chain interoperability, but not specifically for the purpose of payment channels.
Yeah, true.
I think Plasma
ARC,
might be a good example.
Oh, maybe.
It's less so about the payment channels, but it's about reading from the state of different channels. So I can read that you have 10 Bitcoin here and you have 10 Ether here, and you can effectively lock those into smart contracts, or however in the scripting language of Bitcoin, and read this in a Plasma chain. and then effectively have credits where you can interrupt those things and then redeem them on the other chains.
Yeah, nice. So Plasma or Arc.
Yes.
I'm curious about the Ripple network.
Yeah.
Was it all built from the ISO 5 years ago, or who's it sponsored?
ISO or
Their
ICO?
nodes.
Yeah, so you just download it. Anybody who wants to download it just downloads it.
Yeah, but how the infrastructure of Ripple?
The software. So they have developers
No, the
that.
hardware.
Okay.
The hardware. Who's
The
it owned
nodes.
by? Who's-
Nobody. That's the point.
Nobody.
That's
The
exactly.
nodes, is it just like Bitcoin? Is it all
Yes,
over the world?
it's just like Bitcoin.
Because
So,
my impression from reading it was bank sponsored.
oh, they participate and they certainly pay for their participation. They're also investors in Ripple, but really just any bank, any person just downloads the software, starts running a node. So it's not, it's not a centralized orchestrated architecture.
Okay, so the nodes themselves are not hardware intensive like that.
They're not like a
Ant
mining
farms for
node.
Bitcoin, like a mining.
No, you don't need a separate ASIC. You probably do need some sort of system requirements, but it's not at all centrally owned or anything like that.
Do you know if you can run a Ripple node in Docker or?
I don't know. I don't see why not. I heard of other people running test projects, or mostly I've heard of the Ledger or Fabric, IBM's Hyperledger Fabric being run in Docker nodes in enterprise use cases, and I don't see why you couldn't run a Ripple node that way, but maybe you can't or shouldn't. Don't know.
Cool. What other questions? Steve?
In the case where a payment channel is open between a buyer and a seller, and there's no credit assurances, so deposits are made by both parties.
Yes.
Normally, the transaction closes successfully in those deposits. There's a net settlement, those deposits are returned.
Yes.
What happens, or how are folks handling those deposits if in fact the terms of the agreement are not met and the sale does not go to settlement?
Yeah, usually already now with Bitcoin scripting, there's a 3-tier technique for this with different kinds of check time lock signatures and multi-sig. And so if there was no activity, say 30 days after the specified end of the contract, then it might be disgorged per certain terms, and then some other similar thing 90 days later. So there's a built-in tiering for what happens in that kind of a situation. And or furthermore, like we start disagreeing. And so how to handle that and not rebroadcast the transaction and put the funds at risk.
So, Jason, okay.
No, first of all, great presentation. I'll give you a round of applause. My question for you are, what are your thoughts on the IMF's position on blockchain cryptocurrency, as well as the possibility, or i.e. rumor, of the SDR coin coming out soon?
Oh, I see. IMF, like the International Monetary Fund.
Correct.
I don't know their actual position, but it's quite handle for many different agencies to come out with a coin, and I think it makes all the sense in the world, and especially in those kinds of applications to track the end use of the coin. That's a whole to fight capital flight and corruption and aid getting to the end party. It's a huge international problem. It also wind in the identity. So I was talking to somebody yesterday about the application of AIDS drugs. 40% don't get to the end recipient. They get shrunk along the inventory line. So what if you have your digital health wallet with your identity, and so to record you actually did receive that particular item. And so I can imagine aid currencies being the same way. I can imagine Bitcoin MOOCs. So we have, like, I want to do a smart learning contract. Speaking of smart contract for another currency, for a learning currency, I want to finance a kid's reading contract in country X, and they give some sort of proof of truth of having completed their reading this week, and I'm happy to disgorge the funding for their next week of activity. So personal learning contract, or personal development contracts. So I think these kinds of, I love it that the UN has a number of initiatives like this, and IMF might also start having some of these kinds of things.
So Jason, I have a question that you brought up prior to the session, but, and I don't know
On the
if you,
Lightning,
on the Lightning, you came up with two sources of posts, blog posts or whatever, that question something about the Lightning networks. Would you mind talking about that?
So there are some arguments against Lightning as a decentralized scaling solution for Bitcoin. The argument being that the way that the nodes or the node graph kind of pans out is that you end up in a scenario where the deposits or the ability to get funds from one node to maybe 3 hops down the road, you run into certain nodes that intercept this and essentially do something like rent extraction, where they're forcing large fees in order to move forward that transaction to the next hop.
and especially if fees are dynamically priced, that's sort of an interesting thing. And I think some of the other points in that article I tried to wind into my description, which is, well, what if it's a 20 hop transaction? Maybe that's going to be expensive. Maybe there's an extortionist node. Also, does that mean I have to have 20 times escrow floating in the whole network? Because the whole point is to net settle, not massively gross at another up level the gross settlement. And how is this going to work? Also, I'm not checking my wallet 24 hours a day, so I'm not even being helpfully passing through transactions on my node. So I think all of these, and there were some interesting mathematical proofs of why Lightning can't work. So this goes under the category, it's really wonderful that we're completely experimenting and loudly arguing about how all of this can work. And when I first heard of Lightning, I thought two things. Wow, that's the most amazing idea ever. And, oh my gosh, it's so convoluted, it can never work. So I think it's parsing through how to make it work in a specific case. Then we start to have some standard use cases. I think it's different, like personal finance. So then all of this other statistics about transactions. So most transactions are very small, between two local parties. So it's only very rarely that I buy a new appliance, for example. But most daily transactions are low value. And also I'm not typically transferring money in a 20 hop transaction. Although I think individual finance has more hops to get to the next party than probably the Ripple network, which is why I mentioned most transactions resolve are between 1 and 3 hops. To the final party. But I think in personal finance, it will be probably more than 1 to 3 hops. But your smart work should just ripple across the network. It shouldn't be that hard to find nodes, and then nodes develop reputations as well. And so it's just like internet routing that it just ripples. We don't have to worry about this later. Malicious nodes are quickly identified and tossed off. And all of these, the escrow, probably we have a better way to do a net cleared escrow, or it's like a credit card. So why do you have to transfer the whole amount? Maybe do a hold kind of idea or something. So I think we did figure it out, but I love that we're identifying all these possible issues of why it can't work, so we can work on making it work.
Yeah, I would agree. And to add on that, I feel like this whole area right now is one of the most fascinating for blockchain, be it Lightning, be it Plasma, be it Raiden, in terms of the types of applications that we have to now basically play around in this playground with. There are all kinds of economic incentives we can toy with, or financial models. For instance, opening secondary markets based on the IOUs that you're trading. For instance, maybe there are cases of rent extraction, but what if all parties offered up a reward token as well as the person opening the payment channel, so that when you traverse through a certain route, and maybe as you're traversing through that route, you're getting some kind of incentive to keep that channel open, so that maybe that other party can do something with your IOUs and maybe open a secondary loan market or whatever it might be.
Right, absolutely. You get a flowering of creativity.
So Melanie, I have a question for you. What would you say are the top 3 areas in the world that are really pushing the blockchain conversation forward, doing interesting experimental work, prototyping, and so forth?
Financial services, supply chain, and health.
No, but I'm talking about like Berlin, Switzerland. So that's interesting too. FinTech, supply chain, and what was the other one you said?
Health chains.
Health chains.
Health chains.
Okay,
health
cool.
Chains. So I think, well, I was in Germany a couple of weeks ago, and it's very impressive, the uptake and excitement and participation. So Germany, Zug, Switzerland, of course. I don't have a good view on the global scene though. My sense is it's popping up everywhere. So I don't know if any regionality is more or less. I mean, I think it's going on in very many markets worldwide. I think groups like yours allow people who are curious about it to find out about it, learn about it, start startups in it. So I think that's really great.
Cool.
So yeah, sorry, I don't have a better regional answer.
The fact that you don't means that there is this sort of ubiquitous
distributed
innovation going on in this space, which I think is encouraging. What's the most exciting, interesting thing that you're seeing in this space right now?
The thing I noticed is private chains. People are like, I am so over these traditional, I'm doing Monero, I'm doing Zcash, I'm doing all these other, I am out of this system. And so that's been surprising to me, the energy, zeal, effort, excitement to get a payment, a Lightning node running, and to try these alternative methods. So I think it's like 2008, we just get pushed so far, and this Equifax thing has really pushed a lot of people to galvanizing people into using these solutions. It's not as much a curiosity anymore as maybe a necessity.
So the trust factor of centralized organizations being the trustees for our data, that the volume of that conversation is going up in terms of I don't trust you anymore.
Yeah, and then taking responsibility for doing it myself.
Yeah, I want that responsibility. So, okay, these will be the last 2 questions. Go ahead.
Hi, my name's Eric. I'm a second Boston at ASU, and I'm more interested in the policy aspect of it, and I'm actually going to be writing a paper in the spring on how to make Arizona become one of the top states in the country for forward-looking policy and kind of next generation blockchain. Wait, what?
A regulatory arbitrage haven. To be like the Delaware C Corp of blockchains.
Something like that. I'm trying to, you have to find the balance. That's what I'm learning about. So I was interested in what you said that payment channel policy regulation should be coming out in a year or so. Is that speculation, or is that just your
complete speculation?
Complete
So
speculation.
the key point is regulation lags.
Yeah.
Right. So I've been trying to participate in the accounting. I have an MBA in accounting and finance from Wharton. I've been trying to participate in the accounting regulations, and accountants have no idea, and it's about the whole landscape. So the key point is just the the level of knowledge in the general vernacular is lacking. So there's no potential talk yet of payment channel regulation.
Okay.
But you can obviously see it if you just learn about what it is and you see the issues.
I'm just trying to gather much research.
So what if Arizona and the Regulatory Arbitrage Excellence Initiative defined favorable legal accounting treatment for payment channels? And that's an amazing thing to go with the governor's initiative that you have here, which you had to talk about this a couple months ago.
Right.
Yeah,
we had, for those of you that might not know, we had Paul Watkins of the Arizona Attorney General's office did a presentation on Mark Brnovich, who is the Attorney General, has proposed a fintech sandbox, basically. And one of our members has done a lot of work in the regulatory realm, writing it up, and it'll come before the Arizona legislature soon, hopefully by the middle of next year, and hopefully we'll get a thumbs up. But it would the spirit is that our policymakers see the vision of this and they're interested in creating a friendly environment for innovation in this area.
Yeah, fantastic. So that'd be a great thing to define. Legislation of the future, or a regulation, regulatory framework.
We got a second question here.
My name is Shahan Matana. I'm also a second-year law student, interested in blockchain and smart contracts. I guess one of my concerns was you listed R3's Corda on your slides. I know we didn't directly talk about it, but they're basically a permission-based blockchain, and a lot of the nodes are within financial institutions. So I feel like we're still keeping the hegemonic.
Oh, sure. We have like private chains and public chains.
Right, over the blockchain, and some of their description of how they document transactions was concerning to me, because it seems like not all of the nodes keep a copy of each transaction, and so no one really has a full ledger. It's only individual nodes that are involved in the transaction. For example, Wells Fargo and Bank of America completing a transaction between themselves. So I was wondering, how do you feel about that in terms of privacy being within only a couple nodes versus them taking, I guess, a zero knowledge proof type of confirmation too?
Absolutely, the latter. So this is why consortia, private chain consortia implementations are stalled, or haven't been moving more quickly, because nobody trusts each other or the system. So if you have some sort of, I think zero knowledge proofs are just as applicable in enterprise private chains as in public chains. And so if you have, and I think moreover, what I noticed also recently is chains have to have both public and private aspects at the same time. So it's fine to be using Monero and Zcash to have privacy on the public chain, but then later I need to actually recover the basis of that asset that I bought on the chain. So I for record keeping, I need data from the chain. So it needs to be sort of, I think the more sophisticated chains will start to have both public and private aspects simultaneously, and then we flag how we want that to play out on our transactions. So that's one point. They really, in the future, they probably need to have public and private aspects at the same time, both enterprise and individual chains. And then I think exactly, it's very problematic, this R3 Corda. So on the financial industry, financial services, the successful implementations I hear about are more like one party with their clients or two parties, a partner pairing, not really a consortium. And so I think we do need, of course, why would I settle on a chain where the nodes don't have the transactions and the consensus mechanism is not clear? And so I think it's just an indication of a lack of maturity of the solution. And certainly it's quite concerning, and I can't imagine parties implementing these solutions unless some of these issues are resolved. So I think absolutely that high class of thinking is great. Let's get a ZK, zero knowledge proofs implemented here on our R3 Corda chain. It makes all the sense in the world. And it has to have my private record keeping capability, my record keeping capability for myself internally, but also privacy amongst my trading partners.
Yeah, that's a great question. This nature and private nature, but also I think what we're talking about, what we're touching upon, is we are in a shift where something new is emerging. But there's still a tendency to use the old thinking and old paradigms and try to apply it to something new. I've been in the telecom space for years, and I saw the same thing happen in telecommunications when the internet was introduced. All of a sudden, and especially in the regulatory realm, it was like, okay, how are we going to apply tariffs, the old copper line tariffs, to this new internet thing? Well, guess what? You're not.
Yeah.
Because it's a brand new area. And yesterday, Jason and I attended something called the ICO 2.0 Summit in Santa Monica, which was about 200-300 attorneys. in a room together, you can imagine. And the bottom line was nobody knows. Because they're really trying to take, it's actually beyond taking a square peg and trying to fit it into a round hole, because it's not even a peg. It's something else. So anyway, that's, I think, part of the essence of your question is how can you have nodes that only have, no ledger or part of the ledger? That's counter to the entire concept. So I think we're going to wrap it up for today. And thank you so much, Melanie, for being with us. Melanie's off to another speaking engagement. Just some upcoming things. First of all, on the 29th in this room, 7 to 8:30 p.m. and we'll open the doors at 6 and for the pizza and the networking and all that stuff. We're planning to have lightning talks. So 10 lightning talks, 7-minute segments, 5 minutes to present, 2 minutes for question and answer and change out. That's the proposal at this point.
And the lightning talk doesn't have to be about lightning.
Correct. Correct. It's going to be about
November 29th.
November 29th, which is a Wednesday, which is our regular monthly meeting time. Let's see. Above and beyond that, anything else, Jason, that you can think of? Look for news announcements on the carbon removal trading platform, when, and the hackathon.
Yeah, there should be a press release next week.
Yeah. Afterwards, after all of our sessions, we go over next door to the Canyon 49, basically bar and grill for additional networking. Part of our opportunity of getting together is to get to know one another and find out what you're working on, what your interests are. If you're brand new to the space and you don't know blockchain from Chainlink, that's perfect. You're in the right place. And please, reach out to somebody and say, hey, will you explain this thing to me? Our intention really is to continue to build community here in Phoenix and Arizona and beyond. So I would like to acknowledge Jeff. Jeff has driven up from Tucson to be with us today. Corey.
I'd like it if you would please clarify one thing you asked us to do, Melanie, is for your book. Can you clarify what you're looking for from us and what are our deadlines to get it to you?
Sure, thank you. So I have a book project on blockchain economics, economic implications of digital ledgers, of distributed ledgers. Looking for 4,000-word book chapters. That's about 8 pages, single space, 12-point font by March 1st. It comes to me. The publisher is World Scientific out of London. And my co-editor colleagues are at UCL, London, Japan, and Australia, Worldwide Blockchain Economics Institutes. It's really on any kind of blockchain, economic implications of blockchain topic, very broadly. There's a one-page CFP at blockchainstudies.org on the homepage, and it lists probably 27 different kinds of economic topics like that this could be about, but it's really looking for your vision about the economic implications of blockchain. Again, 4,000 words, March 1st, and you turn them in to me. Thank you.
All right. If you have any resources or comments or questions or topics that you'd like to see addressed here, please feel free to post on the meetup page. Right now, that's our most viable community communications channel. We're looking at and working on something that's possibly more dynamic than meetup, but we haven't settled on anything yet. So Thanks for attending and really, really appreciate your participation. So.